The man who predicted the 2008 financial crisis just made his biggest bet in years. Michael Burry is shorting the AI rally, and not just Nvidia, he is going after Caterpillar, the 100-year-old bulldozer company that somehow doubled because of artificial intelligence. Let me explain what he sees that Wall Street doesn't. First, let's look at what has happened. In 2026, the semiconductor index SOXX is up 81%, Micron is up 209%, Applied Materials 124%. But the real surprise is Caterpillar, up 61% this year and 172% since early 2025. A company that makes excavators and diesel generators now trades at 53 times earnings, higher than most tech stocks, and the reason is 3 letters, AI. Here is why. AI data centers need insane amounts of power, and the US electrical grid can't keep up, so companies are building their own private power plants next to their data centers. American Intelligence and Power just signed a deal with Caterpillar to deploy 2 gigawatts of natural gas generators for AI infrastructure. That is enough to power 1 million homes. Caterpillar's power generation sales are up 44% year over year, and their order backlog hit a record $63 billion. So what is Burry doing? On the 30th of June, he posted on his Substack. He no longer files 13FS since shutting down Sign Asset Management, that he is short Nvidia at 198, Applied Materials at 729, Tesla at 416, Caterpillar at 1061, and he is holding puts on the SOXX semiconductor ETF. 2 days later, he added Micron at 1052. His words, the market has jumped the shark. Absolutely non-stop AI. Nobody is talking about anything else all day. Burry's thesis centers on one chart. The Philadelphia Semiconductor Index is trading more than 65% above its 200-day moving average. The last time it was this extended, the year 2000, right before the dot-com crash wiped 75% off the index. His quote, a pure form of overvaluation in an index, a form that is rarely seen and never so easily recognized as such. Now, the bulls aren't buying it. Hyperscalers are spending $750 billion on AI infrastructure in 2026, with 75% going to AI. Analysts argue this isn't like the dot-com era. These companies have real revenue, real customers, and real demand for compute. And Caterpillar's data center power business isn't a one-time cycle. Operators are building permanent private microgrids. But here is what you need to know about Burry. He made $100 million personally on the 2008 trade, and over $725 million for his investors. But since then, his public calls have been hit or miss. He called a crash in 2017. The S&P rallied 19%. He tweeted sell in January 2023, and the Nasdaq had its best first half in 40 years. He even admitted, I was wrong to say sell. One analysis of his post-2008 calls found 71% were directionally wrong. What is different? This time is structure. He rolled his SOXX puts to March 2027 expiry, giving himself over a year for the thesis to play out. He moved from $300 strikes to $400 strikes. He is not betting on an imminent crash. He is betting that $119 billion in non-cancelable supply commitments and a $5.45 trillion semiconductor valuation can't survive even a modest slowdown. Is Burry right this time? Maybe the man sees patterns others miss. That is undeniable. But being early and being wrong look exactly the same when you're holding puts. The only question is whether that March 2027 expiry gives him enough runway. I'll be watching. Let me know what you think in the comments.